Good afternoon, ladies and gentlemen. Welcome to the IQGeo Group PLC Group Preliminary Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and you'll be notified once these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Richard Petit, CEO, and Hayward Chapman, CFO, IQGeo Group PLC. Good afternoon.
Good afternoon. Thank you very much, Paul, and a warm welcome to everyone. It's really good to see you here. So I'm Richard Petit, as you can tell. We've got a presentation here for you today that will cater for, I think, a wide audience. So we will assume a very low level of knowledge about us. So we'll tell you something about us as a company, about our products and as a market. And in addition to that, we'll tell you something about the results for fiscal year 2020. So I'll start at the beginning and tell you who we are and what we do. So IQGeo, we're a software company, and we develop and sell a software solution that is focused on geospatial productivity and collaboration for telcos and utilities. So that's something of a mouthful, but we will spend time in the next few slides describing exactly what that means. But in a nutshell, what we are about is helping network operators in industries like fiber, 5G, electricity, water and gas, helping them improve the productivity and improve KPIs around key processes such as sales, planning, design, construction, and maintenance activity. So it's quite a specialized field, but I think it's a field that is an attractive market from an investor perspective. There's a lot of investment going into these spaces. And in our opinion, this market has a number of, I think, really distinguishing features that make us a really interesting investment. So let me start by telling you a little bit more about IQGeo as a company. So we're relatively small, but we are global. So we have offices in the main markets that we act in. So North America is a very big market for us. In fact, the majority of our customers, staff, and revenue are in North America. But we also have presence in Europe. We are headquartered in Cambridge, and we have another office in Frankfurt. And we also have a presence in Japan, which is another key market for us. We have 260 customers at present. The number of customers went up quite considerably at the end of last year when we made our first acquisition, which is a company based in Salt Lake City, Utah, and they brought about 200 smaller customers with them, and that brought the total number of users to 50,000 users. So we have one vision in terms of what we do for our customers, but today we market two distinct product lines, one aimed at tier one telcos and utilities, and the other one aimed at tier 3 and 4, or what I call first generation fiber network managers. Our background is really in the geospatial market. So the company was founded about 10 years ago by a team of geospatial engineers who had recently been bought out by GE. And after their earn-out periods, they left and founded a new company, which over the years has finally become what we are and being branded as IQGeo. We are a company that all we focus on is telco and utilities. We don't do other markets, which means we have a network focus. And our team has a lot of expertise in that market, and really we have world-class expertise in those markets. We sell a product as a subscription. We made the transition a couple of years ago very successfully. The vast majority of what we sell today is subscription. And on occasion, we sell a license, and usually that's down to regulatory reasons. In some states in the US in particular, OPEX cannot be passed on to consumers as part of a price raise. only CapEx can. So in rare instances, we still sell license models, but the majority of what we sell today is subscription, which builds our growing revenue, and that's very much our growth story. Most of the selling we do today is direct. We find that it's easier to control and better to forecast. We do sell quite complex products with long sales cycles. However, an important part of what we do is through channel. We have very strong channel partnerships in Japan in particular, where we partner with NEC, and they're doing really a fantastic job with us, getting us into tier 1 accounts there. In fact, our largest single subscription was achieved via NEC with Tokyo Electric and Power, and that was a subscription we signed up late in 2019 and then was expanded rapidly in 2020. We are a high growth business, as many of the KPIs Hayward will tell you about, and my job is to tell you why that is, which is what I'll be doing in the later slides. The last thing to say is we are a cloud and SaaS deployable business, and of course this goes hand in hand with subscriptions. So the product we provide is really built around Amazon Web Services and a whole series of capabilities and tools there, although we do work with other market-leading SaaS products. SaaS is a key part of our value proposition, both for performance and price reasons. So I'll hand over to Hayward now to give a quick flash on our financial KPIs.
Good afternoon, everyone. I'm Hayward Chapman. I'm the CFO at IQGeo, and I'm just going to run you through some of our key financial highlights initially, and then I'll come back to you later on. I'm going to go off camera for this piece. So I'll focus firstly on our recurring revenue. So our exit annual recurring revenue increased by 165% between 2019 and 2020 to 5.3 million. Now, 2 million of that exit annual recurring revenue came from the acquisition of OSPI, which we completed on the 21st of December. But actually, the IQGeo sort of organic growth rate in our exit ARR was 65%, and that was from 2 million to 3.3 million. In terms of our in-year recurring revenues, that increased by 96% to 3.2 million, and that was all of the recurring revenues were IQGeo revenues there, because obviously we acquired OSPI right at the end of the year, so there's very minimal amounts of recurring revenue in that 3.2 million figure. In terms of our recurring revenue order intake, so this is the sort of the annual recurring amount times by the number of years for which we contracted with a customer, our order intake grew by 152% to 6.3 million versus 2.5 million in 2019. So, I think those are really good figures. There's some big percentage increases there, which were very pleasing. In terms of our own product orders, they grew by 42%. So this includes the recurring revenue order intake. But we have other products like our perpetual licenses and also our services. So including those, that grew by 42% to £10.7 million compared to 2019. And our own product revenue increased by 32% to £7.3 million. We had an increase in the gross margin percentage by 10 percentage points to 52%, and that's a combination of the sales mix, so a greater level of recurring revenues, and we achieve about 89–90% gross margin on our recurring revenues. And we also had a good year in terms of our services, which increased from 2019 to about to 2020. So we're achieving now about 25% margin on our services as well. We also track amongst our KPIs our new logos won, and that remained static at 13 in 2020 compared to 2019, which, considering the sort of the year when the pandemic started, we're quite pleased with. We'd signed up 5 new logos at the half year. I think there was a slight slowdown as we went into lockdown on a global basis, and then we saw a slight acceleration in that to get back to the 13 for the full year. And the reason we focus on new logos is because our strategy is very much one of land and expand. So our net retention rate on our recurring revenue for 2020 was 140%. So we're seeing a lot of instances where our customers come back to us, and we sell them more products across our product life cycle, which Richard will come on to, and also we're selling them a greater number of seats and of additional users as well. So we're really pleased with that net retention rate. We had a 120% net retention rate in 2019, and going forward we would expect to have a net retention rate of somewhere between those two figures. In terms of our net cash at the year end, we had 10.5 million of net cash on our balance sheet, which was a 20% decrease from the prior year. So we're still burning through cash at an operating level, but that burn rate is getting much less, as I'll come on to show you later. Post year end, we received 2.5 million from the sale of a minority stake in the RTLS business, which was a business that was demerged from IQGeo back in 2018. And then we also received some tax credits as well in terms of R&D. And so actually at the 31st of January, we had 13.1 million pounds worth of cash on our balance sheet. We increased our headcount during the year by 35%, up to 96. And I'll show you a geographic spread of where those employees are located and the areas in which they work in later on. 18 of that increase was due to the OSPI acquisition, but we also, towards the end of the year, we also increased our headcount organically in areas like sales and development and our support functions. So I'll now hand you back to Richard, who's going to take you through some further slides.
Thank you, Hayward. And I can see here we've got some really great questions coming in. I want to reassure you that those of you that have asked questions, I will answer them. Some of them are in later slides, so please be patient, and I will answer them as we go along. But please keep sending them. It makes it much more interesting for us. So a couple of slides on the solutions and applications. So this is a slide we use to explain our product positioning, both internally and with the customers and investors. I talked earlier about being a geospatial productivity and collaboration tool, and what this really means is that we provide what we call an end-to-end geospatial platform for our customers. And what we're doing here is that we are providing a solution that allows customers to handle all of those activities that take a network from the drawing board all the way through to being a live revenue generating asset for its customer. And so the typical functions you can see here are sales, marketing, planning, design, construction, operations, and maintenance. Now, this is actually our positioning here to be able to do all these, or to offer this as a single solution to our market, is actually quite unique. Typically, what you'll find in the market is that our competition sit in one or more of these circles, and they will not worry too much about what's happening upstream or downstream from them, which leaves the customer with the challenge of having to find an application that can do, say, construction or operations and maintenance, and having to do all that integration themselves. Well, we fundamentally disagree with that. We don't believe that the customer should be out trying to create Frankenstein solutions to handle what is really quite a natural workflow. And so we believe that because these activities all rely on common data, in other words, the network data, it makes a lot more sense to have them hanging off the same database, and then managing routines, activities, and jobs inside each of those departments with appropriate workflows and appropriate tools. And so that's exactly what we do. So in each of these departments, we have very compelling stories and use cases and ROIs. Most of the use cases revolve around reducing the time it takes to do things, or the number of people it takes to do things, which is very relevant, as I'll show you later on. And everything we present on this slide is, is functionality that we can demonstrate, that we have live somewhere, and is referenceable. So this positioning is special, and in particular, what is unique is our ability to bridge what are called sort of head office functions and field functions. And that's really important because the network, everything that goes on around the network doesn't just happen in one area. Typically, it involves collaboration between departments, activities being described or planned in head office, and then could be conducted out in the field and often handed out to subcontractors. So it's a very sort of it's a relationship that requires a lot of management, a lot of governance, and a lot of data flows. So the IQGeo product is the flagship product that we've developed in-house, and it was really expanded to cover this end-to-end vision a few years back. It has been doing very well. Now, more recently, we purchased a product called OSPI. OSPI really specialize in the planning and design area here. So they're really conceived as a system of record, but they were designed for what we call first generation network users, or tier 3 and tier 4 users. Now, the reason we went after OSPI was A, they had a very interesting customer base, and B, very good recurring revenues. But more importantly, they address a piece of the market that we could not go after with the IQGeo product. Later on, I'll explain what they do uniquely and why that part of the market is so interesting. But since we've integrated them, we have expanded their product range. So today, the OSPI product has now been extended to the right, and we have already launched some capabilities in the operations and maintenance area using web viewers. Based on the IQGeo code, but packaged up using the OSPI brand. And this has already resulted in some +1 sales through the OSPI customer. So I'm going to try and answer some of the questions I can see here. So in terms of typical subscription rates, with IQGeo, we tend to go after larger operators, which start at 100+ customers, some of them reaching up to tens of thousands. The subscription rates there will vary anywhere between $150,000, $200,000, all the way up to $600,000, $700,000, $800,000 per year. The OSPI is very much on a smaller scale, so the per seat values are similar, but the OSPI product tends to sell in sort of batches of 10 or 20 seats, because that is the typical size of the customer. They have a much faster sales cycle, and they're addressing a much faster market in some ways. In terms of our growth strategy, we're all about land and expand. So it's quite rare that we will go in and sell all of these capabilities and modules to a particular customer. More often than not, we're in and solving a particular pain point. So right now, for example, where there's a lot of build out and happening in the telco market, but quite often we'll go in on construction, where customers are having trouble getting jobs done on time, working with subcontractors, getting visibility of their work in progress and things like that. So there are very often pain points there that we can go in and solve and accelerate the whole construction process. Another area we can work that is doing well right now is automated planning and design, particularly for tier 1 companies that have to design fiber networks for many thousands of homes, millions of homes even, and optimize the whole design down to lowest cost. So there's interest in those areas, and that's an area we can go in. But wherever we go in, the idea is we get the customer live, get them happy, and then from wherever we have gone in and landed, we will then look upstream or downstream, and see what other opportunities are available in terms of upselling. And the same is exactly true for OpenReach. So what that means is over time, what we find is once we have a good working relationship with the customer, they will return year after year and buy more modules and buy more users from us, which means that quite frequently in year 2 or year 3 of a relationship with a customer, they will be buying more than they did in the original contract signature. So the upselling capabilities that are inherent in our market and inherent in our product strategy are actually very, very good. So in terms of our competitive differentiators, and I'm going to start talking about our customers here, our competition here as well. Our main messages to our market is, first of all, that we are built exclusively for network operators. Many of our competitors bring generic geospatial products and then rely on partners or plugins to make them understand networks. The problem with that is it takes a lot more time than it does with a dedicated product, and also the product customers wind up having could have substantial differences from one installation to the next, which means they're hard to maintain, and they're also very hard to extend and customize. So we don't think it makes any sense at all for a customer and telco utilities to be building out their own custom geospatial solutions, any more than it makes sense for them to be creating their own databases or operating systems. It just doesn't make sense. Our other unique differentiator is that we operate across the network lifecycle, which means we're bridging different classes of applications. And the most important bridge we build is between the office and the field, so between systems of record and mobile systems. And so that allows us to integrate data sources, eliminate silos, streamline work. And so, we're all about, creating measurable improvements in operations. The next two differentiators are more technical, and we call ourselves a mobile-first solution. And this is really to differentiate ourselves from the older sort of client-server solutions that we're competing against. The reason mobile first matters is because it is a much more efficient way of handling large volumes of data. So rather than insisting that lots of data has to be brought into a big data lake and analytical tools applied to that, which is a very sort of 1990s conception of the world, we don't care where the data sits. We can sit in our database or anywhere else. But more importantly, we can combine all these data sets and work on them in a virtual database, if you will, in a virtual memory. And we're very good at parceling up data and pushing it around the enterprise and allowing groups of users to do different things with the data. So all of that's made possible by a mobile-first architecture. Last but not least, we are cloud native. This is extremely important as well. Unlike other systems we sell against, our product was designed to work in the cloud from day one. And what that means is it has really fantastic performance, particularly when handling large data loads. But at the same time, and this really matters for cloud native products, the performance can scale down when it's not needed. And so what that means is particularly customers who are paying as they go only pay for the performance they need and when they need it. The last thing I'll point out to you here on this slide is that we call ourselves a system of action. And again, this is in contrast to our competition who talk about a system of record. System of record indicates, certainly underlines the importance of data, and we would agree with that. Data is important. But what's more important is what you do with the data and how it is used around the company to drive performance and to drive KPIs and to drive profitability. So for us, a system of action is a much better description of what we do, and I think it encapsulates our philosophy really quite well. Now, one of the things that changed in 2020 was how customers engage with, interact with vendors. Particularly on the enterprise side of the business, we deal with quite long sales cycles, and sales cycles that, pre-pandemic involved quite a number of visits to a customer and workshops and whiteboarding sessions and things like that. Now, under pandemic, all of this disappeared, and what we found customers are doing is spending much less time with vendors face to face and really constraining them to quite sort of narrow slots within their sales cycle. And in turn, what they're doing is spending more time doing their own research around the vendors they want to work with. So we've adapted to that. We've put a lot more content online. Here you can see a whole range of customer testimonials representing different industries, different use cases. But the messaging around each of these are very consistent. Customers talk about their satisfaction with the solution, what it's like working with us, the impact our solution has had on their organization, and generally the success of the project as it was conceived. So this is very important content, and we see that we get a lot of visits from prospects in these areas as they do online research. The other areas where we've been investing very heavily is in our sales and marketing tools. We use a market-leading platform called, oh, Hayward, I'm drawing a blank. Anyway, we use market-leading technology. HubSpot is called, called HubSpot, which allows us to really apply a lot of intelligence into the whole lead generation process. We're very targeted in terms of which types of personas we go after, and our technology is able to score their interest in what they're doing and build up a profile of these users, what they visited, when they visited it, and suggest when the time is right to be putting calls into these people to try and engage them. So there's an awful lot of really intelligent tools out there today that we're using as part of our go-to-market program, and I think a lot of that we will continue into the future because actually I think a lot of the changes in the buying processes are permanent, we have a strong marketing platform here that we will continue to use. There's a question here on why are we being more successful in the US than in the UK. The business was born in the US, so when we were Ubersense in the UK, we tended to focus on the other side of the business, which was more manufacturing oriented. In the US was where the geospatial business grew, and so it really has a head start on other markets we've been in, and as a result of that, more customers. So there are no particular reasons other than that. Another question here: do we integrate with workforce management software platforms? Yes, we do. We integrate with all the market leaders there. It's quite useful to have geospatial capabilities alongside workforce management, we've done integrations with IBM Maximo. We've done integrations with other leading platforms. There's a few of them out there, and we collaborate with them. It's a highly symbiotic sale. So I'm going to talk a little bit about the market now. OSPI is a new brand we've brought into our telco piece. Even though it is a fiber product, actually it does expand our addressable market. So it gives us access to segments that we wouldn't have addressed otherwise, such as government, industrial, universities, corporate, etc. And that has actually quite substantially increased our addressable market, and I've got a slide on that later. Being able to address a better market obviously is good for our forecast and good for our growth prospects. We're very happy with the acquisition of this company. Slide here to explain how we differentiate between OSP Insight customers and potential IQGeo customers. As I mentioned earlier, OSP Insight is all about first generation network users. Now, what's important about these types of customers is they tend to be smaller, don't have large IT departments, and very often typically they are moving off paper-based records or very simple systems, and putting together, trying to get this into their first digital system. So what's important for them is to have low cost of ownership, very, very easy to use systems, easy to understand, easy to implement. And the OSPI Insight product is unique in the sense that you can get a fully fledged fiber management system installed in just a handful of days, sometimes less than a week. So that's exactly right for that market. The IQGeo product, on the other hand, is really intended for much larger users who are integrating disparate systems around the network, have many thousands of users, and have many departments using it, and need high performance. So this is really so the differentiation here is important because it means that we can go to each market segment and target them with messages that are appropriate to that individual market, rather than going after trying to approach the market with a one-size-fits-all message, which is what much of our competition do. As we look forward, the two code lines will be integrated. In fact, the next version of OSPI and the next version of IQGeo are the same product. So this will give us synergies at the development level, which means we won't need to develop things twice. In fact, the new version of OSPI Insight is already being sold in Europe, where we don't have an OSPI customer base that will be comparing features and functions. And when we reach full feature parity, we will start pushing the new product into the OSPI market for upgrades and other things. So effectively, we will have one product with two brands and two levels of packaging, if you will, that are appropriate for each market. With our investments in SaaS and cloud, the long-term goal is to move the entire customer base into a single instance that is multi-entity, and that will create really good performance and lower cost of ownership, and will give us the ability to introduce more services and more feature sets into our customer base more easily. So I'd like to say a few words about the market, because I think it is a very important driver for our success, and I think really explains much of the reasons we're doing well in this space. As a CEO, I say there are many things I can control. I can control my organization, I can control my go-to-market strategy, I can control my product, but it's very, very hard for me to control demand. And so what's important for me is to understand what are the markets doing, what are they spending on, and whether I can tap into that in order to secure growth of what I'm trying to do. So I'm pleased to report that our markets are very, very resilient. So first of all, in telco, both broadband and 5G continue to attract very high levels of capex in our markets. I'm sure you're all aware that the demand for broadband services to the home and fiber to the home has really been growing very, very highly around the world with the pandemic, and I think we're seeing changes in work habits and so on that are set to continue. Also on the mobile front, 5G is proving a hit with customers. Mobile customers are happy to pay a premium for 5G services and 5G broadband and 5G handsets, and so network operators and telephony companies are looking to cash in on the interest there. So there's a lot of money going into 5G networks, and I've had this question before. The fiber network at the core of both of these markets are actually very similar. The main difference is in the last mile, where for a broadband service, you've got to terminate the fiber connection at somebody's address, whereas in mobile, the termination point is a 5G mast. But beyond those differences on termination points, the networks are designed and managed in very, very similar ways. So investments in this market remain very significant. But the North American market, which is a key market for us, has other, I think, features that make what we're doing very, very interesting. The first graph on the right shows you the percentage of investment that is going into fiber networks, segmented by operator type. And what you can see here is that 88% of the market is actually owned by very small fiber operators, so non-tier ones. And in fact, this is reflected in the kind of take-up we're seeing for our OSPI product. Last year, OSPI signed up 40 new logos, and this year they're on track to do the same or even more. And this is a phenomenon that we're seeing repeated in other key markets. Here in the UK, for example, about 50% of the fiber to the home market is owned by small operators, so not by Openreach. And in fact, we're seeing a huge amount of activity there, and we're signing customers in that segment as we speak. So it's a very fertile market, something of a land grab happening now. And our goal is to sign these customers up very quickly, and then have them on our platform so that we can continue upgrading them and upselling them and cross-selling them. In terms of runway left in this market, there's a long way to go still. In North America, again, as a for example, only 40% of homes have been passed with fiber to the home, which means the 6% is left to come. So we can, certainly in the fiber to the home market, we continue to see growth for many years. Now, the reason we're doing well, and I think it's important that we understand the link between CapEx and our product, is, I think, expressed very well in this slide here. On the left here, you can see employment figures in the telecommunications market, and you can see that employment has been steadily declining in telecommunications, and not only for general functions like call centers and things like that, but also specialist functions like linesmen, installers, and repairers. And as I mentioned earlier, this is in contrast to the very large amounts of capex and network build out that is happening in the telco market. And so the reason these two things are possible is because of increases in productivity, and improvements in productivity really come from digital tools and software. And so there's no doubt that digitization of activities is at the heart of this increase in productivity. And we know telcos want to be favorably compared to other high-tech industries like the FANG industries, Facebook, Amazon, and so on. And the key to that is improving gross margins, and the key to improving gross margins is reducing payroll cost. So we see this reflected in the ROIs that are calculated around our product. Typically, they're around saving time, saving personnel. We've got some very, very compelling ROIs for all of our modules, and we know that when a customer comes to calculating ROI, our products are really going to shine. And from that point on, we're in good shape from a forecasting perspective. But it's not all about telco. We see huge potential in our energy markets as well, and much of that is being driven by climate change. And so climate change is changing the way particular electricity is generated and distributed. There is consumer changes in demand, not just for the energy sources, but actually things like charge points, the advent of prosumers, digital meters, storage challenges, and so on and so on. And this means that electricity generators and distributors have to invest in what are called smart networks, which are very different to the kind of networks that were being run before, that require a lot more intelligent software and sensing capabilities, and require much more dynamic management, because as you all know, carbon-free energy sources can be volatile in terms of when they decide to make themselves available and or not. So with this complexity comes much more complex hardware environments, and therefore much more complex software environments in terms of the tools required to save them. Our product is absolutely essential for managing a smart network, not only in the field but in the office. And one of the most important things we do is keep data current around the network. Around the network configuration, which is extremely important for these multi-million-dollar network management solutions called ADMS, which are the Advanced Distribution Management Systems. Regulation is also our friend in this market, and in the US, for instance, despite the efforts of recent administrations, there is an awful lot of carbon neutral legislation going through. California, for example, has legislated for 100% clean energy by 2045, and there are many others following suit, and all of this is resulting in renewable energy being brought into these networks, and thanks to legislation changes alone, we're going to see the equivalent of about 10 Hoover dams deployed over the next 10 years in terms of renewable generation capacity, and of course all of this is driving additional complexity in these networks and additional employment, which creates further opportunities for us. So in fact, the further out we look, the more important we see energy becoming. It is also a larger market in terms of individual actors and target companies, more fragmented market. There's been less consolidation than in telco, so for us it represents a very significant opportunity. I had a question here on distribution or partnerships around energy. Much of what we do in the energy space is partnered up. So we do have relationships with some of the big providers of energy management systems. So we have a very good relationship with Oracle, which is a leading player there, and others. And this gives us access to some of these very large bids that are happening every year in this market. So we've had some questions on the competition, and this is a slide that kind of explains what's happening with our incumbents. So we talk about the incumbents are the manufacturers who really landed in this industry first. Most of them around 20 years ago. There's 5 of them that we talk about, which we can't mention by name because these are our opinions about them. But I think most of you can that know anything about the geospatial market can probably recognize at least the first. And what I would say about the incumbents is that they all kind of suffer from the same problem, which is sort of represented in this middle column here, which is that these products really are aging now. They all suffer the same problem of being architectures that were designed in the 90s and do not port well into today's cloud-based and web-based infrastructure. As a result of that, their roadmaps really lack compelling new features and new functions for their customer base. Most of these incumbents have really not taken much interest in what's happening around them, and really have not taken the whole network lifecycle very, very seriously. I think a lot of these companies really have quite an inward-looking view and probably take things like analytics too seriously for this market. Analytics is very important for other markets like disease control and all kinds of things like that. But for the network, just being able to run analytics on a fixed infrastructure is not terribly interesting. So they don't really have very exciting roadmaps, and so this has left their customers with a problem of trying to meet their internal demand with different technology. And so this creates an opportunity for us. We can come in and fill a lot of those gaps between the system of record and what the wider user group needs to do. And once we're in and solving those problems, it gives us the opportunity to start forklifting these older system of records out and replacing them entirely with our own system of record. So I would say the action or inaction of these incumbents, in addition to the activity in the market generally around CapEx spend in both telco and in utilities, really creates a significant opportunity for us, which I think is reflected in the kind of growth rates that we're seeing. The last slide I'll talk about is the addressable market, which I referred to earlier. So our market, with the acquisition of OSPI, in the geographies that we are present in today, so that's North America, Europe, and Japan, and a few countries around Japan, we target 17,500 companies. Expressed as an ARR, they're worth over 1.7 billion a year. The smaller part of that is telco, but I would say the telco market is hotter right now because there is very significant demand now. As we look further out, the utilities market will pick up speed. It's already doing quite a lot now, but I think in time we'll see more and more activity there, and the value of that market is significantly larger because there are more players. Okay, so with that, I think I'm going to hand back to Hayward for more detailed financials.
Hello again. Yes, I'm just going to run you through some more of the detailed financials. So I'll start with a summary of our income statement. Our revenue grew by 17% in the year, from 7.8 million to 9.2 million pounds, and our gross profit grew by 47% to 4.7 million, helped by that increase in the gross margins to 52%. Our operating expenses stayed, well, they were down slightly. Obviously, we spent less on travel, and there's a lot of, there have been in prior years quite a bit spent on travel between our offices, and also we cut some marketing expenditure, some trade shows and other sort of live events. But we've got a very strong digital marketing campaign, which I think has helped us secure new logos during the year. As a result of all of that, our adjusted EBITDA, or the loss of our fell from 4.8 million pounds to 2.5 million pounds, definitely in the right direction, and that strong trajectory upwards is forecast to continue. So just going into our revenue summary a little bit more, I've talked about our recurring revenues, which grew by 96%, and now that forms 35% of our total revenue, up from 21% in the prior year. Our software, which is our perpetual licenses, decreased by 81%. So that was from 1.6 million in the prior year to 0.3 million. Now we expect that to fluctuate as we go forward. We've already signed a perpetual license deal in January with Shaw, which was a major Canadian telecom company, for £700,000 with 135k of annual recurring revenue for the support and maintenance. And we're forecasting this year about 1.1 million in terms of our perpetual licenses. And as I think Richard said earlier, in the North American market, customers are not allowed. Our customers are not allowed to pass on, or some of our customers are not allowed to pass on operating expenditure to their end users. That's why they favour the capital license model. Obviously, selling more product, our services grew by 65% to 3.8 million, and we achieved about a 25% margin on that. So our own product revenues overall increased by 32% to 7.3 million. We also have a third-party services line, which is where we have a small number of customers, 3 or 4, who use us to complete services on their GE Small World product, and that it's decreased by 20% from the prior year, and we expect that to continue to decrease, and by FY23 we expect that to disappear completely. So overall, despite the reduction in that third-party services and the low software element that we had, we still managed to increase our overall revenue by 17% to 19.2 million. In terms of cash, I've got a reconciliation here of the cash at the start of the year and the end of the year. We had operating cash outflows of 2.8 million. We had a positive working capital movement of 0.5 million, and the majority of our subscription contracts we're getting paid annually in advance. So as we continue to grow, I'd expect that positive working capital movement to recur year on year. We spent 1.5 million on capitalised R&D, and then looking at the bottom of this table here, you can see the effects of the OSPI acquisition. So we spent £4 million buying OSPI. We do have some deferred and contingent consideration that gets paid out at the end of this financial year and at the beginning of FY22. To fund the acquisition, we raised £5.2 million from shareholders, and you can see that as well. We also received £700,000 for the US equivalent of the furlough scheme, the Paycheck Protection Plan. We fully expect that loan to be waived, and we're currently in the process of getting that waiver put through. So the figure you see, 11.1, is the gross cash position, but the figure I showed earlier on right at the start of the presentation was obviously our net cash after taking out the effect of that loan. Just in terms of our summary balance sheet, net assets increased by from 15.6 to 18.1 million. We had big growth in the intangibles, which is a combination of our capitalised R&D and then the effects of the goodwill, the customer relationships, and the acquired software from OSPI. There's the investment of the RTLS Smart Space business, which we sold in January, and that's now disappeared as an investment. Our trade and other receivables increased from 2.4 to 3.3 million, some of which was due to OSPI, but some of which was due to the growth in the business. And our trade and other payables increased to 5.1 million, and we would expect that, included in that is deferred revenue, and we would expect that to continue to grow as we sell more subscriptions. You can also see the deferred and contingent consideration there at 1.5 million. And then we signed a new lease for our Denver office, which is included there under IFRS 16. And you can see the bank loan, which I referred to earlier, the Paycheck Protection Plan. But again, I expect that to be forgiven this year. Then my last slide, just on our just to give you an indication of our headcount summary and what areas we've got our staff in and where they're based. We've got 96 staff in total. 18 of those came from OSPI. We had, if you actually look at our statutory accounts, our average number of staff in the year stayed very static because we only started to recruit right at the end of the year when we had more visibility of our pipeline and forecast. But we've increased the number of technical consultants we've got. We've beefed up our sales and marketing. And actually, in January, we've got the European MD from one of our competitors, 3GIS, started with us heading up our European operations. We also increased the amount of R&D staff that we have, and that's split across Denver and our Cambridge office. And then in terms of split by geography, by far the biggest location is North America with 72 staff. We have 18 staff in Cambridge, and then we've got a small number in Europe and Asia. But as Richard said earlier, we're very strongly supported by our partner network in those geographies. Okay, so thank you very much. I can see some questions have come in. The last one was, are you considering further acquisitions? I mean, obviously, it's something we will look at. We've been very pleased with the progress of OSPI. I think they sold 46 new logos last year, and we're seeing that sort of run rate continue. They've got a much shorter sales cycle than we have. And actually, they sold, one of the customers they signed up last week was the first one of their customers to take our mobile product, which we've already integrated our mobile system into their system. We're hopeful that that will prove quite a big upsell item. So yeah, we're really pleased with OSPI. If we find, we'll be open to looking at further acquisitions in the sort of the areas in which we operate if they're deemed to be right at the time. But we've got 140% net retention. We've got some strong products, so we'll if we just grow through organic growth, I think we'll consider all options really.
Fantastic. Richard Hayward, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Richard Hayward, obviously we've had a number of questions come in during the meeting itself, and some of which you've addressed during the presentation, so thank you. If I may just hand back to you, and if there are any other questions that you are happy to run through and answer, please, if you could just read out the question, that would be great. We've got about 8 minutes until the end of the session, but do feel free to carry on if you wish.
Yeah, actually what I'll do is I'll just walk through all of the questions and make sure we've answered them. The first question was, size scope of a subscription, we've done that. Is there obvious, so are we going to get more growth from greater penetration or from new logo acquisition? We're aiming to do both. Obviously, it's cheaper and easier to sell to an existing account. So we work hard on having account strategies and making sure we can upsell and cross-sell into those. But also, as some of the market data I've shown you, there is a lot of growth in new business as well, particularly coming from the lower end of the market. So we want to make hay while the sun is shining there and try and get those on. Are there countries where we are not present and we would be looking to do so? Yes, so there are some areas we're looking to expand to, particularly Southeast Asia. There is a lot of investment going into mobile and fixed line networks there. We think we're probably going to approach that using channel. We are based in Japan, but Japan is not a great location for handling Southeast Asia. There are some, I would say, cultural differences there. So more than likely, we have to find partners in markets like South Korea, Thailand, Vietnam, Hong Kong, places like this. So that is something we'll be looking at probably next fiscal year in order to underpin or take advantage, ride more of the growth that's out there. Competitors, we had a slide on competitors. Are they doing similar things? Well, our competition, our incumbent composition has a very different mindset, and their architecture makes it hard to add mobility. Bolting mobility onto a client server product is extremely hard, and very often what happens is you wind up having to build a separate mobile system and then sharing data between the mobile system and the system of record. That means you've got to fix things twice and develop things twice, and it makes for a very ungainly architecture. So much more elegant to have a single solution that can do both. So our competition do try and address some of the problems, but we would argue their solutions are not cost efficient and not really performant. Do we, question here on NEC as a partner, do you work or compete with Ericsson or Nokia? This is something we're looking to see if we can achieve. One of our board members, Andy McLeod, was CTO at Vodafone, and he has good relationships there, and he's working on my behalf to see if we can expand some relationships there. There's a question here on technical debt. So how hard is it for customers to remove software and services in various areas? Well, the answer clearly is that it is hard, particularly in the utilities area, but actually also in telco. Our customer mindsets tend to be very safety conscious, and turning things off that are more or less working is difficult. We tend to do well when a system in a particular area cannot be further upgraded, cannot be enhanced, and is really causing performance problems. That is often a very good driver for getting things out. It's very common that we will go in and do parallel runs and trial runs and really satisfy the customer that what we can do is better. But there is a definite trend towards reducing technical debt. A lot of our customers see the value in having a single application do the job of 4 or 5. Making, simplifying, data integration, simplifying operations, simplifying communication internally is definitely a popular theme with CTOs. Continuing down the list, any partnerships for India? We do not have partnerships in India. If you could recommend any, very, very happy to look into those. There is opportunity in India, but it's not something we would try and do direct. We think it's a much better market to be done via channel. How much growth is coming from networks, from new networks, as opposed to maintaining an existing? We don't see a difference in those two things, because typically network maintenance and network growth goes hand in hand. A network that's being used today is a network that's being upgraded and being grown out and expanded. We only see replacement happening, from one generation to another. So, copper is definitely being replaced by fiber. Coax is definitely being replaced by fiber. But once a network is on fiber, we see equal demand for expansion versus maintenance. So not a significant difference there. Interesting question here on data use. So is there a network effect by working closely with new logo and mapping their operations in geospatial data? So the key point to underline there is that the customers own their own data. So we don't we have no right on the data, and we wouldn't want ownership of that data. It's very important that customer data remains theirs. So there is no data effect for us, and we don't have any plans to start using or reselling the data in any way. However, there is definitely, I would say, a knowledge effect. So as we learn how customers do one thing particularly efficiently, that's something we can build into our software, and we can take from one customer to the next. And very often that's one of the most compelling reasons for buying a product from a specialist vendor rather than doing it in-house, is the fact that we've got experience and expertise. We know what best practice looks like, and that's very much part of our pitch to customers, which is that we've seen these things done many hundreds of times, and we know what works and we know what doesn't work. And we're in a good position to tell customers when things are a good idea, and most importantly, to tell customers when they're a very bad idea, and to avoid them making costly mistakes. So hopefully that answers all of the questions, and I see our time is now coming down to 17:30. So,
fantastic. I was going to say thank you very much indeed, Richard. Just perhaps if I could just ask you for a few words to wrap up before we redirect investors to give you some feedback.
No, all I would say is, for those of you that are investors, thank you very much for your support. We love having you on board. We are looking to build a really attractive investment here. We are focusing on recurring revenue. We are focusing on break even. We are focusing on growth, and we're very excited about the prospects of this business. We'd like you with us for the long term, and we hope we're going to be a really good investment for you.
Fantastic, thank you. Thank you again, Richard Hayward, for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback. If you've accessed this meeting from our website, the feedback page will appear. If you've accessed the meeting via the link sent to you by email, you'll simply be asked to just log back in and give your feedback. It only takes a couple of seconds and would be greatly appreciated by the company. On behalf of the management team of IQGeo Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.